We're streaming?
Yeah, we're
Okay.
live.
All right. Huddle, huddle, huddle.
Hodl. Save, save, save.
Save.
Build a,
Builder,
build a,
builder,
build
builder.
a.
Sound
Sound
money,
money,
sound
sound
money.
money.
All right. This is Ugly Old Goat. Just getting on to do a live stream and do a read through. One reason that we're live streaming now is that Arthur Hayes is going to be doing, what do they call it, Twitter
Spaces.
Spaces. And so hopefully we're going to listen to it, but maybe I'll get invited on because I am, my wife, the goat lady, does use Bitmex. But I want to read my experience on using the Bitmex token. So I call it Bitmex Popery, and my experience and lessons used learning to use the Bitmex rewards token. And that's what I call it because really that's just what it is. It's a rewards token. Uh, doesn't really need a token. They can offer rewards, which they did before without a token. But uh, any,
Yes.
okay, so we are going to be listening.
Okay, well, it's 1 minute to go, so I guess we might as well start. So, welcome everyone to this Twitter space on cryptocurrency interest rate swaps.
Okay.
So, joining me is Arthur Hayes. Arthur is the co-founder of the cryptocurrency derivatives trading platform Bitmex. Bitmex rose to prominence towards about the end of 2017 with its innovative Bitcoin perpetual swap derivative contract. And more recently, Arthur is known as perhaps the best and most prolific blog writer in the space. Also joining me is Simon Jones, who is the CEO of Bolts Labs. And Bolts is a DeFi protocol and automated market maker system where you can trade interest rate swap contracts. And the most popular contracts on there, I believe, are the US dollar stablecoin rates on Aave and Compound. And I'm Jonathan Beer. I'm a blog writer for Bitmex and recently published a book on cryptocurrency interest rates called Reckless, the Story of Cryptocurrency Interest Rates. So, welcome everyone. And I guess we'll start by hopefully keeping it quite simple. So I don't know if Simon, if you can explain just the basics of what an interest rate swap is.
Sure, and I guess first of all, it's obviously awesome to be here. It's probably helpful just to actually start with setting some context. So, interest rate swaps in traditional finance, it is the biggest market in the whole of traditional finance. In fact, it is cartoonishly large. There's around a quadrillion of notional traded each year in TradFi interest rate swaps. But before Vaults was launched, that number in DeFi was zero. Um, and then I guess just to explain kind of what an interest rate swap is, essentially it's a synthetic instrument that lets you exchange one rate for another rate. And in the simplest form, what kind of that typically looks like is you can trade a variable rate for a fixed rate into the future. And the creation of all those different fixed rates into the future enables you to construct what's described as the yield curve. And once you have that, there's all sorts of different things you can do. And I think the three main buckets really for what interest rate swaps can be used for is, first of all, speculation. So you could believe that rates are going to go up or down in the future, and you can do that. You can basically place trades around that with pretty significant leverage. The second is around hedging risk. So, for example, you could be borrowing USDT. Obviously, we had the depegging event recently of USDC. USDT borrow rates went up. If you had kind of entered a swap on Vault's protocol for USDT borrowing rates, you wouldn't have been exposed to that. You'd have just had a fixed borrowing cost, so you can hedge that risk. And then the third kind of bucket really is around using an interest rate swap to construct products. So that could be structured products. That could be, in the case of traditional finance, stuff like fixed rate mortgages for retail. So it's a really widely used instrument, and by now having it in DeFi, and obviously we're super excited about the fact that Bitmex have also launched a similar product. It has opened up all of these different use cases which weren't possible before.
Well, that's great. Thanks very much. Yeah, Arthur, I don't know if you want to talk about it as well and just give your view on the role of interest rate swaps in the traditional kind of macro economy, and what you think might happen in cryptocurrency and whether interest rate swaps could adopt a similar kind of role.
Yeah, so I mean, I don't want to repeat everything that was just said because it's spot on in terms of how large that market is. How it's going to impact crypto, I think, is really going to take a center stage in, I think it's next week, but someone else can correct me if I'm wrong, when the Shanghai upgrade goes from the staking contracts.
Can everyone hear? I can't hear you. But yeah, the Shanghai upgrade's due to happen on Wednesday next week, so the 12th of April.
It's fading in and out for me as well, just for what it's worth.
Okay, yeah, so yeah, Arthur, if you can. But yeah, Simon, I wonder what you think, because on the 12th of April when the Shanghai upgrade happened.
Yeah, so, and that's why people are swapping, USDC, USDT rates, but there is no crypto implied yield native to those particular stablecoins. But with the ETH proof of stake and the Shanghai upgrade, now your ETH actually has a yield because you can stake your ETH and earn rewards for being a validator in the network. And that means that ETH is now this commodity that has this yield attached to it. And that yield is quite important because it's, what is it, 4 or 5% once enough people start staking their ETH. And that's a meaningful amount of money because people have been wanting income from this crypto that they hold. Now, Bitcoin being pure money doesn't have any inherent yield, but Ether is something different. And now it actually has a yield. And this is going to create a whole new ecosystem of products and services around, okay, I have this yield on my ETH. Is someone going to pay me a yield on my ETH if I deposit it on an exchange, for example? Should I get a variable rate for just having my ETH on a centralized exchange? If I want to borrow ETH, that rate has to correlate to what the validators are getting paid, whether that's a variable or a fixed rate. And as you start asking all these questions of what will the rate of ETH be generated in the future, given to validators, now you have a situation where I need to either take a view on that, whether I want to earn fixed or I want to earn floating, or if I'm offering a certain type of product, what type of risk do I have embedded in that? Because my customers are going to expect that they're going to receive something for giving me their ETH. And so, given that ETH is, a few $100 billion market cap coin, this is really going to jumpstart the market for interest rate derivatives in the crypto space, because now we have, the number 2 largest crypto asset has an implied yield that is denominated in itself. And so it's a super big, super important milestone. And I think it's really going to unlock a whole new type of trading and hedging and speculation. And, it's going to be really, really fun.
Yeah, that's really interesting. I mean, Simon, I don't know if you can maybe try to give an example of what you think is the most popular interest rate derivative product or type of thing people will do after the Shanghai upgrade on Ethereum. What is the main thing people might want to hedge?
Well, maybe if I talk from what we're observing on Vault's protocol at the moment, because obviously the Shanghai upgrade hasn't taken place yet. So the most popular markets actually on Vault's protocol today are the stablecoin markets on Aave and Compound. And there are kind of people who are trading those markets to speculate from a directional perspective. They might be trading it to hedge. But actually, by far, one of the most popular use cases right now is to arbitrage across different markets. And in many ways, the rate markets that exist in DeFi today are equivalent to kind of like the spot markets that existed a few years ago, where there's huge arbitrage. In that instance, is across exchanges. In this instance, is across the rates that might exist for Aave USDC lend rates on Ethereum mainnet version 2 of Aave versus version 3 of Aave versus mainnet to Arbitrum, for example. And what you can do on Vault's protocol, and what we're seeing a lot of people doing, is they are arbing those different rate markets because they expect them to converge. If we take this across to post-Shanghai, frankly, we kind of expect similar dynamics to start to play out But in that instance, what we'd expect people to start doing is we'd just expect people to start arbitraging across like financial primitives. So, for example, the ETH borrow rate on Aave, you would expect that to start to converge to the ETH stake rate that you could get on, say, Lido or Rocket. So one of the big trades which we're kind of drivers of volume that we're expecting, particularly in the short term, is we're expecting people to start arbing those different rate markets that exist, given the inefficiencies, because it's so native, so nascent. Longer term, obviously, what you can suddenly start doing is kind of using your staked ETH to do things like build structured products. And kind of when you have a situation where you're using an interest rate swap to fix that yield, so you have predictable guaranteed yield that exists into the future, clearly there's a whole bunch of different things that you can start doing with that. And we're pretty excited about the opportunities that are going to come off the back of it.
Okay. Yeah, and Arthur, I was wondering what's your view on how the Ethereum yield could make Ethereum the Ethereum markets change more to macro conditions. So if Ethereum has a yield, how will traders react if say the Federal Reserve funds rate declines? Will that make Ethereum relatively more attractive because they're going for that yield? And will this kind of how will this Ethereum yield interact with more traditional rates?
Well, so I guess something that is a concept in TradFi is like FX hedged yields. So if you're Japanese or you're familiar with a lot of the Asian FX markets, there are these supranational entities like insurance providers who have all this capital and they have nowhere to invest it at home. So Taiwan, Japan, South Korea. And what they do is they take their capital, they exchange it into US dollars, they buy treasury bonds, and then they sell it forward to hedge the FX exposure. So, and then hopefully what they're left with is a positive yield, which essentially means that they've done a triangular arbitrage and they've earned something that they actually shouldn't have if you believe in traditional covered interest rate parity. But if you come to the crypto space, how does this reflect the ETH? So let's say ETH has a 5% yield, and I can fix that yield with some sort of interest rate swap, right? Now what do? I go and I sell a ETH US dollar perp or an ETH US dollar futures contract out into the future, and that has a cost or an income, right? So if I can remove the ETH US dollar price risk by selling a futures contract or a perpetual swap, and the net yield that I earn is positive, that means that as a US dollar or fiat thinking investor, I can remove all crypto risk and earn positive yield. And so that means that I will want to buy ETH and sell a futures contract, right? Or sell swap. And if you do this in enough size, the premium or the funding rate should actually go negative, because theoretically the ETH yield from staking should equal the amount that I have to pay to hedge my ETH US dollar exposure into the future. But obviously, I'm sure that's not going to be the case at all points in time. And there's going to be situations where I, as a fiat thinking investor, can actually earn a net positive yield with no cryptocurrency risk to my books. And that's going to be super interesting, because when that situation presents itself, you're going to see a lot of size of dollars or euros or yen moving into crypto to buy ETH to sell futures contract to stake it. And obviously they want to have a predictable fixed yield into some period in the future, and they're going to have to use an interest rate swap to do that. And so it's going to be super interesting to see these sort of arbitrage situations where the interest rates in TradFi are going to bleed into what the FX hedge yield of ETH is in crypto. And it's going to drive a lot of interesting trading behavior in much larger notionals than we're probably used to, because if I can earn a risk-free yield with no risk, with no cryptocurrency to fiat risk, then I'm going to do that all day.
Okay, and Simon, do you think is Volts preparing for that? Do you think you're going to see an inflow of more traditional US dollar-based investors trying to capture this kind of risk-free crypto yield?
Well, the protocol's certainly prepared for that. I mean, just if we think about the volume of trading activity that's taken place on the protocol over the past kind of few months since we launched, it's been pretty phenomenal, to be honest. Um, which is obviously great to see, and it's great to see people within DeFi starting to pick up these types of instruments which hadn't existed in DeFi before. To Arthur's point, there's it kind of yes, we do expect that to happen. I think what is kind of exciting from our perspective is obviously Bitmex have now launched an ETH staking kind of interest rate swap derivative. Like what the path is that for these bigger institutions, like what are they gonna where are they gonna trade these products? Are they gonna go straight to a DeFi primitive? Are they gonna go to a centralized venue to start off with? That's still unclear. But by having these different markets exist across different types of venues, it certainly helps build awareness of it and enables like a kind of I guess a richer ecosystem of trading activity to start taking place. For anybody that is comfortable already trading on a decentralized exchange, of which there are many people, obviously Volt's protocol is pretty well positioned to support that trading, um, particularly given the fact that there's been it's kind of like you need the product to be around for a period of time, and by being live before the Shanghai upgrade took place, it means that people have got comfortable with the protocol, the way that it works, the security that exists around it, and we certainly expect it to be picked up and traded more kind of going forwards.
So, yeah, you mentioned the Volts trading volume on Notional. Can you just give a bit more metrics on the kind of volumes you're seeing on
Yeah,
Volts?
so the protocol was launched on the 1st of June last year, which was obviously right after Luna crashed. So it's only ever really been live in a bear market. And despite that, there has been, like, frankly, exponential growth. So it's been about 30% week on week, which now means that there's been over 15 billion of notional traded in aggregate. And as of last week, there's a whole bunch of pools that just matured. But as of last week, before the pools matured, there's about 2 billion of open interest on the protocol, which, to put that in context, I think DYDX was the second largest from an open interest perspective. And I think they had about 400 million of open interest at that point in time. So it's about 5 times larger from an open interest perspective. Um, which is great to see. And there's more markets that are launching. I kind of agree with what Arthur's saying. Post Shanghai, there's going to be these kind of incredible trades that start to exist around staked ETH, and we expect that to continue to drive trading volume on the protocol.
So, I mean, those numbers sound quite large, but I guess that's probably a lot larger than the actual volume of money flowing in and out of your system. Is that because there's a lot of leverage, or how are those open interest numbers so high?
Yeah, so the protocol, there's a few kind of deliberate design decisions that we had to make in order to enable interest rate swaps to exist in DeFi. And one of the core ones was basically separating out the pricing mechanic from the margin engine itself. Um, and kind of what this enables at its core is it enables leverage to exist in the system. And for markets that are kind of less volatile, so particularly the stablecoin markets, as an example, actually in some instances the protocol can create up to 1,000x leverage. Now, clearly, people still have to be comfortable coming in and taking that kind of size and that amount of leverage, but it enables the volume that goes through relative to the margin which is being deployed to be considerably higher. And it's worth saying this is really like having leverage for rates is extremely important. Um, just for example, if you believe a rate is going to go from 2% to 4% over the next 12 months and you do that without leverage, clearly that's not an attractive trade. But if you can do that with 1,000x leverage, actually all of a sudden that becomes really attractive. And that's just from a trading perspective. From a hedging perspective, it's equally important.
Okay, so what is the kind of average leverage on the system? Say if you've got 2 billion of open interest now, how much margin is currently deployed?
Yes, there's close to 10 million of margin at the back end of last week before these pools matured, which just gives you an idea of the average leverage which is being deployed. It's pretty significant.
So the average leverage is about 200 times?
On average, yes. Yeah.
Okay, and how that works? So if interest rates change a bit and you're 200x leverage, how do you get liquidated, and what is the liquidation risk at that kind of leverage?
Yes, you deploy margin to cover your position to maturity based on based on some assumptions that are built into the way in which the margin engine works. Kind of basically, the margin engine defines therefore your initial margin requirement as a trader, and you then have a kind of threshold that sits below that called the liquidation threshold. If your margin moves into that zone, which would require you to be out of the money for a period of time, then a liquidator bot can come in and liquidate your position, which essentially involves doing a counterfactual unwind, so taking the opposite side of the trade. And the liquidator bot receives a proportion of your margin as an incentive in order to enable that. And what that mechanism design ensures is it just essentially ensures that the protocol always remains solvent, and you don't have positions that remain out of the money for a prolonged period of time, such that they cannot support the other side of the trade, if that makes sense. But to actually get liquidated, one of the things that's kind of worth highlighting is, say, unlike just Aave, just as an example, where kind of one of your supply assets could half in value kind of almost instantly, and then for trigger an instant liquidation. That doesn't happen on Volt's protocol. What you would need is the rate markets to change, and such that you're out of the money for a prolonged period of time, and then effectively block by block, your margin is being consumed because it's effectively being paid away to the other side, the person who's in the money, until you hit the liquidation threshold. So you actually have typically got a period of time within which you could either kind of top up your margin to avoid being liquidated, or you could choose to unwind your position yourself.
And just a question, and forgive me that I'm not super familiar with the intricacies of your protocol, but how do you guys protect against a situation where somebody essentially just takes out entire supply of a particular coin and jacks up the rate, almost to infinity because they've done some sort of like maybe a flash loan attack or something like that? Do you guys have like sort of a stop out where essentially people get stopped out of their profit on the other side to protect the integrity of the system?
Yeah, so this is again, it comes back to this point that it would have to be a prolonged change in the rate environment in order for people to end up getting liquidated. So if someone did a flash loan, for the most part, that actually wouldn't. I mean, you always have one block where the rates change significantly, but for the most part, that wouldn't affect the P&L of either side. But if you were able to move that rate market up to, I don't know, like 100% APY over the course of kind of several days, that is going to kind of push the protocol or push the people on one side of the trade to be out of the money for such a prolonged period of time that they could get liquidated. But for someone to do that over a period of time is obviously is a much harder attack vector, versus an instance where someone could just do it within a block, right? And the point there being that someone doing it within a block or doing it within a short period of time, that doesn't result in liquidations.
Okay.
So what if someone wants to bet on, say, short-term volatility in interest rates? Does that mean that you can't really do that effectively on Volts? Because with Ethereum, it's possible that there could be kind of short-term spikes in the yield, which some people might want to speculate on.
You can still trade that on vaults. It's more, sorry, I was more talking about from a liquidation risk perspective. So if there's a short-term change in the rate environment and you've got a trade on Vault's protocol, that's obviously going to be reflected in your P&L, and you can take those positions with pretty significant leverage. Just given the construction of the protocol, in order for someone to move from kind of a safe margin requirement into the liquidation zone, there'd have to be a prolonged change in the rate environment to cause their margin to effectively be consumed such that they've entered that liquidation zone.
Is that because you're just basically a smoothing average function in terms of wherever you're considering the last variable rate of?
Yeah, so we use essentially a version of a TWAB, which goes into the margin engine itself. But it's also because the margin, like, so if I'm out of the money, then on a block by block basis, I'm effectively paying P&L to the other side, and that would have to take place over a prolonged period of time, such that each block I'm paying away my margin to somebody on the other side until I actually enter the liquidation zone. Because maybe the other way of saying it is the P&L associated with the swap, it accrues on a block by block basis.
Okay. One other topic that might be interesting for both of you is GMX, because I think the rate you can earn there is quite volatile, and I think Simon Volts has had a lot of volume there. And I know Arthur's been talking about GMX as well. So I don't know if any of you have any comments on GMX and the GLP rate you can earn on that.
Yeah, it's interesting to hear how you guys are fixing that.
Yeah, so on Volt's protocol, there is a market on the GLP rate. What's kind of interesting is these two things happen completely independently, but there was a governance forum post from the GMX team kind of considering introducing a mechanism that helps smooth the GLP rate, just given it's actually pretty volatile. GMX token holders voted against that, but actually because the rate market exists on Volt's protocol, it creates a natural marketplace where the people who want a smoother rate can trade that, and the people who don't want a smoother rate can actually lever up their exposure to the variable yield. But what we've seen, which is pretty interesting, is because that market is so volatile, you really do have these two different sides to the market, where you have some people who are wanting to essentially fix their yield over a prolonged period of time, and this other side of the market that's wanting to get kind of levered exposure to that variable yield. And it's driven quite a lot of trading volume on the protocol, which is pretty interesting to have seen. And what's interesting as well is because on Arbitrum that kind of rate is actually paid out in ETH, and you only need ETH to trade on Volts to post margin. Sorry, in order to enter that market on Volt's protocol, you only need to post ETH in order to start trading. It's effectively, I mean, it is definitely different, but it is a very, very high yield generating ETH asset, which is interesting, and people are coming in and doing all sorts of different things with that, equivalent to some of the things that they'll do with staked ETH.
Okay, yeah, Arthur, I think you might have to go in a few minutes. Is there any other comment or any other interesting information or views you have about interest rate swaps and how they could kind of be a significant part of the cryptocurrency space in the future?
Yeah, I guess at a very, very, very high level, like the types of risks that are going to be able to be exchanged between people are going to put to bed anyone who claims that, oh, I don't want to be in crypto because there's no yield, or and I've got all these deposits in all these exchanges and it earns me fuck all. Like, what am I doing here? I should just put my, go back to dollars and earn 5% on my on treasuries or whatever it is, right? So the ability for this market to exist is going to allow a lot of people to be very, very creative about the different types of yield products that they offer to cater to different segments of the ecosystem that require certain types of things. And this is only going to increase the interest in crypto because, okay, yeah, there's a 5% yield in treasuries, but that only really applies to people who can access that particular financial system of the West, which is, a few 100 million people, if that, right? And so we're talking about a global marketplace of, billions of people, most of whom can't earn a treasury yield, but can they earn, ETH because they're able to get, buy some crypto or some other proof of stake coins that adopt a similar sort of reward system as Ethereum. So, these types of products are going to allow like the billions of people in the world who crave yield, who don't have access to, high quality government bonds of the West to actually earn this similar sorts of yield in crypto and really increase their adoption because now they can say, okay, I'm getting some income into my account, every day, every month, every year, whatever the time period may be. This is a really good investment for me and my family because I'm actually being able to pay for things that I otherwise wouldn't have been able to because, okay, yeah, I can make 10% in some local currency bond, but inflation's at 50%, right? So what am I doing here? So not only do I have an asset that is more resistant to, TradFi inflation, but now this asset actually earns me a native yield. I think it's just a super interesting and super compelling proposition for the bulk of the world who is not part of a banking system that is stable. And even saying stable in regards to the Western banking system is giving it a lot of props, but there's a lot of other ones that are even shittier than that. So I think this is going to be super interesting. If you're a big derivatives, wonk, you're going to love all the types of funky things that, creative people are going to come up with on the internet. And it's just going to be more and more trading. And it's just going to drive the industry forward in terms of the types of people who interact with the different things that we've created. So I'm super excited. I'll definitely be making, investments across the space, whether it be, trading vehicles for yield, different primitives, whatever people come up with. So, me and my team at Maelstrom are definitely clued in on like liquid staking derivatives and, the burgeoning interest rate swap market and fixed income derivative space for proof of stake coins.
Well, thanks so much, Arthur. Yes, Simon, I don't know if you have any closing remarks or any other comments or views.
No, just that I'd agree with that, and I think what's really exciting about it is kind of crypto so far has really worked as an alternative place for people to put their money. It's like it's an asset that exists, to use some of Arthur's language, an asset that exists outside of the system. What's really interesting with particularly staked ETH and the various other rate markets that are starting to exist, and all of the innovation that is obviously taking place in DeFi, is it's not just now about giving you the option to put your money outside the system. It's actually also the ability to have a financial system that exists outside the traditional financial system as well, which really gives people kind of way more options beyond just holding assets. You can actually start to do stuff like generate yield on those assets and kind of all the various other things which we're coming up with in DeFi, so that there is this entire alternative ecosystem that gives people a choice, and that is pretty exciting.
Yeah, absolutely. Okay, well, thanks very much, Simon, and thanks very much, Arthur. I hope this was interesting. And yeah, that's the end. So thanks, everyone, for listening.
Cheers, Jonathan.
Bye.
Bye now.
All right.
There.
Well, that was a bit disappointing. Are we alive?
Yeah.
Okay. They didn't really say very much at all. But I got in because I wrote an article. I've been playing around with this silly Bitmex token, and basically I've done some other analysis on it. They're all linked on this article. And I start out with the article, show me the rules and I will play the game. I played this game and I haven't figured it out yet. I don't know if it can be figured out because it really is. What these tokens really are is they're reward programs that are centralized and really depends upon, they can be changed at any whim. And so I start out, this is not anything new. I mean, we just had 2022 as a debacle where we had one platform after another go under and take everybody's funds. And I've experienced that in the past. I mean, it seems like I'm smart enough now. I didn't lose any funds last year on these these unsound banks or exchanges, whatever you want to call them. But in the past, I have. I mean, I was caught up in Cryptsy, where lost everything. Script CC, you know, and I also weathered the 30% haircut on Bitmex way back there in, I don't know, 2016, I think it was, or whenever. And I've had other hacks, So in that regards, the BMX token is it's like a Sunday school picnic, and I don't want to differentiate. It's not fraudulent at all. I mean, it's outlined what it is, and it is what it is. So uh, uh, people tend to blame uh, when they lose in the marketplace. People tend to blame everyone but themselves. So I'm not. I mean, I'm basically. I mean, I know what I'm doing. I went in there with my eyes open and knowing that this could not work, or maybe I don't know how to make it work. And of course, so far that's been the case. So, but a lot of times these funds blow up and they'll blame the
Really?
exchange or people that are on the exchange. They were enticed for some kind of an interest rate or return, and of course they lost everything. That like people that were trading on FTX. And what has happened is people, rather than take self responsibility, they want to blame. Uh,
Other people?
they want to blame someone else than themselves. And the best thing that can happen is, that markets cleanse this stuff out quickly, and that's a good thing. That's not a bad thing. But like I say, I've seen even some people that I know in the industry when these funds blow out, they'll blame Bitmex because they were over leveraging, or they were screwing up. Can you scroll up? And I'll keep reading the article here. Scroll the article up the other way, down, I guess.
Oh.
Okay. So. And so all these failures this last year, this creates a groundswell of support for nanny state protections. Oh, we need to have regulations by the SEC or other things. People, have been mad at all these as at, the shitcoiners because, well, they're a security and they need to be regulated. Well, not really. What the SEC, my mentor at EC Harwood identified the SEC as the third greatest swindle in the history of mankind. The first one, of course, is inflation. Second one is entitlement, and then SEC or regulation is the third one. Regulation never helps anyone, except maybe it helps. For example, your CFTC and your SEC. These regulatory agencies are usually created by the industry themselves, and what they're really doing is they're just making it harder for the average Joe to enter these markets. So the point is that a consistently successful trader learns to deal with loss, and it's a way of thinking that most people just don't possess. Consistently successful traders often lose, and we know that there are no magic beans in trading. There's not. So, and probably the best guy I've seen that has outlined this and understands it thoroughly. He actually wrote a book, and I love the title because it explains it in 3 words. Best Loser Wins, and it's by Tom Hogarth. And he actually is an active, large trader that trades in real time publicly because it's his way of holding himself accountable. I do the same thing. All these people that promote these magic beans, oh, you can make millions, and trading all this. They don't publish their track records. They don't show what's really going on. They'll pick a few trades, say, well, look what I did, and it's really not a reflection at all of what they do. So unless somebody is publishing their trades, you really can't. You're taking their word that they're a successful trader. So my good friend, who's unfortunately passed on before his time, Tyler Jenks, he used to say that fundamentals are finding the right market and money management trump all technical analysis. And he was a great technician, but he recognized that finding the right market, and of course that right market was Bitcoin. And this sentiment was also echoed by Wells Wilder Jr. and he wrote a book. And you actually can read the book there. I found it online, so it's free if you want to read his classic book. It's New Concepts on Technical Analysis, and it really outlines a lot of different how a lot of these indicators were originally formed. Of course, there's an infinite number of points between A and B. So TA is really something that it's a creation. It's not really science. It's more like astrology than any science. But you can, get a feel for the market by you can't look at every indicator because there's infinite number of them. But by picking a few, you can establish a feel for a market. And so what he teaches in his book is, first of all, you need a good technical system. You need to use a system in the right markets at the right time. And so I think Bitcoin is definitely the right market. Timing is everything. And then you have to, third and most important is using the correct money management technique. And of all of these three, money management is the most important. And it's the easiest to learn and the hardest to do. That's why I emphasize this over and over again, guys. People think there's magic beans. They think there's something you have insider knowledge or something, successful traders. That's not the case. In every case, it's money management. When I blow out, and I just did, and anyway, it's because you're not managing your funds correctly. And so I like being accountable to other traders because, like I say, as long as you can play the game, you'll eventually get lucky. So I'm going to again outline my experience with the Bitmex token. And so the goat lady actually won the New Year's contest here. I scroll down, you'll see that where she closed out and made $90,000. Just started with a little bit. I think that we went like 20x or 30x, and actually made about 130,000 when it was all said. But we decided to use some of the funds and buy the token because I thought, well, we get a discount on the trading. And originally, when I was started publishing trades, we found that 7% of my profits came because we were a market maker. And I knew I was making money trading, but I didn't know it was that high. And so it is a significant amount that you make if you have a decent rate. I mean, slippage and the amount that you're paying on to trade is a significant factor. Keeps going up. All right. Well, it turned out it's a very bad move, and again blows the performance of since February compared to Bitcoin. And you'll see back there in February the BMEX token was at 90 cents. Since then, it's lost half of its value. Now it has paid a nice yield. I mean, 10% or something like that. I get like 27 BMEX a day, but it hasn't kept up. You're getting this thing that keeps depreciating, and you have more of it. So since its peak of 90 cents in January, it's lost half of its value. You can see it there. Compare it to Bitcoin, and Bitcoin has actually gained 20%. So we'd have been much better off just forgetting the BMEX token and just paying whatever the rate is, and getting the Bitcoin off the exchange, which that's the other problem with money management. We all know that not your Bitcoin, not your keys, not your Bitcoin. So yes, if I'm going to stake BMEX, not only am I risking not having Bitcoin and putting it into a shitcoin, but I also have it on the exchange. So you've got a double whammy risk that you really want to take into account. And so that's what I wanted to point out. Now, in fairness, I do want to point out that on Bitmex, the goat lady, we could have hedged the BMEX. I wasn't aware that how it was done. It's a very thin market, but it's been paying Bitcoin for going short. So, I mean, it was kind of my fault because, again, I'm learning this thing. If I knew what I was doing, I could have hedged the 100,000 BMX. It's 7 or 8, and now it's at 4. And I could have picked up substantial amount on the decline, and also collected a huge amount of funding along the way. So I kind of wanted to outline that. So let's go in. Let's go down again. Keep going. So there it is. I actually in that new. If you want to actually follow everything that I'm doing as I'm learning this in real time, become a plebe member. We just started this as a new membership where you can have a lifetime member. You're not going to be an active participant, but you will have access to my Only Ugly. You'll get my side. Anything that I'm trading, you'll see, as I post things. So we call it Only Ugly. A full paying member has access and can discuss with each other. So, but at least you're getting, what I'm doing and all of my comments. And
Your life, not theirs, right?
It's my life, not your life. So. And I'm getting older by the minute, guys. I don't know how much longer I'll be around, but as long as I'm around, or like I say, things keep not working as well as they used to, and so age is a factor. I still go seem to get around better than people half my age. So hopefully I've got the Lord will give me some extra time here because I have a lot to live for. And do enjoy doing this. So the best way, this is actually one of the members commented this, because I just got blown out of the market. He says, man, trying to follow you, it's like I'm trying to keep 3 balls in the air, and now you're spinning a plate on top of your head. And you know what? That was a good description, because that's what it's the shitcoinery is. Anyway, so far it's been an expensive lesson, but that always is the case. When you get into Bitcoin initially, very few people, look at the lesson that Michael Saylor's had to learn, because he's, look at the lesson that El Salvador Bukele is having to learn. They've all bought, their Bitcoin is substantially higher than, measured in dollars, substantially lower than where they purchased it. So one of the things is that I've learned is because, the staking, every one of these shitcoins is different, but the BMX token has a staking of 14 days. So in order to keep liquid, so I can use that in case I want to, increase my leverage, I didn't realize I need to constantly unstake. And so one of the reasons I got stopped out is because I didn't have the liquidity there that I needed in a position I should not have gotten stopped out. But like I said, I've written articles blowing out at the bottom with a smile. Guys, I can still smile because as long as you can trade, you'll eventually get lucky. The Bitmex token and it's actually promoted as the token for true believers, and apparently, that's kind of true. But your faith is apparently in the Bitmex Pope Arthur Hayes, and it's not the Lord Almighty. So Arthur is a fallible man. He's very good at what he does. Whether or not Bitmex will succeed in resurrecting itself as one of the top exchanges. I know that they created this because they felt like maybe they had to because of the way Binance was launched. And unfortunately, I don't know that it's the best model, but it's what we're living with now. So I'm adopting to it, and so far I haven't done a very good job. So that one thing that they are doing that will help is that they are having a new P&L realization feature of cross margining. So basically what they're saying is you're going to be able to match if you're in a spread. Before they did not link the two. They weren't marked to the market, so you could actually, if you're in a spread, you could blow out of one side and not the other. Well, now they're using the collateral, the gain that you have on one side of the spread to hedge against the other side. That's normal. That's what happens if you're trading spreads on a normal futures exchange. they should have had that all along. So I think it's a good feature. I think it's something that they should have done long a time ago. It's really nothing new or innovative. It's really the way the markets have emerged, many years ago. And so this is something that they just didn't have on Bitmex. Okay, scroll up, and then that was the Oops, scroll up. We just listened to this cryptocurrency interest rate derivative discussion, which I was kind of disappointed on. I don't think they said very much. I don't really get it that much. Maybe there's something to it, but this trading is like the Bitmex token. It's really just a rewards program, and it's a tokenomics. It's not economics. They're no more than a rewards program on an exchange. There is a natural force at work here, and that is the Bitmex token. It is designed to compete with the Binance BNB token and other exchange tokens. So that is a market. Basically, if they want to create value in the token, they're going to have to make it more attractive than what it is. And so far, scroll up, please. So far, I do feel a bit foolish for falling into the trap and the natural inclination to promote the shit coin bag that I'm holding, which I find is true. If you're holding a shit coin, you tend to promote it, and I don't want to be doing that. I'm trying to do this as objectively as I can, and like I say, I might just be getting too old for this shit. That's why I concluded.
That's a good one.
I concluded that.
No, I think you still have a lot to teach and
well,
and for us to learn.
I don't know. Like I say, the principle is the same. I mean, I made a lot of money trading on Bitmex. I think Bitmex is the best exchange that's ever existed. I have every reason to think that it's the most honest exchange I've ever seen, and that's happened time and time again. Where I thought something was funny, but no, I haven't seen anybody that jumps in front of orders and so forth. Now I do seem to think that the BMX token, it's very expensive. The one thing I really don't like about it, if you do convert, there's like a 3% spread, and which is huge, and they also, it's very limited. Like I think when I started, you could liquidate 1,500 BMX at a time, and they've lowered it to 1,000. But I mean, I understand it. It's a thin market, so they're not going to let you just sell, 100,000 Bitmex or convert 100,000 Bitmex. And if you check the market itself, it's very thin on the derivative. But they do have a derivative. I wish that it was more that you could actually use the BMX token as collateral, but they don't, and I don't see how they can, because it's really a very thin market. It is a use case. You're trading a rewards program. Now, whether or not it's going to go up 100x and be worth $5 or $50. I don't know what BNB is. I don't see where they got the value on that thing. But we'll just see. Like I say, I think that so far I have not gotten the hang of it. I don't get it, and I'm not. Like I say, I have no problem trading these things, but you don't want to confuse these shitcoins as being Bitcoin. Bitcoin is sound money, and none of these other things are anything but a very risky speculation. So anyway, I guess that hopes. Again, I want to encourage you to go to the website. If you just hit that starter kit bag. Guys, if you want to follow me, we've got a good program now. Where is it? It's loading.
It's loading.
Huh?
Yep, it's
Why
loading.
did it take so long?
Yep. Oh, okay. Hold on.
Just go to the website.
Well, that's what I'm trying to do. Hold on. It's taking a long time.
I don't know why we can't get to the website. Well, at any rate, go to the website. You can. There's.
Nope.
Oh, there. Bitcoin. Just hit that. It's Bitcoin starter bag.
It's
Show
not
there.
gonna work.
Huh.
It's not working. That's
Yeah.
weird.
You're gonna have to hook that stuff before we get on. So anyway,
No.
go there. The starter bag. We have a digital one version for just $200. You get everything digitally. If you want all the books sent to you physically, which I recommend, it's just $100 more. Plus, you'll get some spiff, and you'll get a jade wallet. And so, at any rate, visit that. Glad you tuned in. Kind of disappointed. I thought there'd be more to it, and I thought there'd be participation. But
I think this is their first time doing it, so I'm pretty sure that's what it is.
yeah, I've never seen them do one before. So I know a lot of people are doing real well with that Twitter Spaces, and I have not tried it yet. So, well, thanks for tuning in, guys.
See you later, guys.
It's what, 3 in the morning here?
No, it's 5 till 4 in the morning, so
Five till
we-
4 in the morning. So
we gotta
did this in
sleep.
the middle of the night. Just to, I was hoping that we might be invited on, and I could cross-examine Arthur Hayes a little bit about the BMX token, and so. All right. Well, thanks for tuning in, and we'll talk to you later.